Audio test 1, 2. Testing audio, audio check 1, 2 to the live stream. Once again, this is an audio test to the live stream. Testing audio. Another test, testing audio. Adjusted the gain on the audio to the live stream.
9:00 a.m. for Long Beach Community College District. We'll do a roll call right now, and then after each action item, if you all don't mind, I'll just open it up for a motion, and then we'll take a second instead of doing a roll call on each action item. Are you okay with that? Okay, wonderful. Yeah. Wonderful. Okay, Vice President of Business Services, Marlene Drinkline.
Here.
Director of Business Support Services, Robert Raposa.
Here.
Director of Fiscal Services, John Thompson.
Here.
I'm Rosalind Washington with Keenan. We're the program coordinator. And then we also have Kristen Cooper on with Keenan, and she assists me in taking the notes for the minutes.
Good morning.
Good morning, Chris.
Good morning.
We have Scott Rankin, Benefit Trust Company.
Here.
And Carrie Allison, Morgan Stanley.
Here.
I think I had invited a guest, but I don't see him here. So that's quite all right. Okay. So there's no public, any public comments? Dario, that would be an opportunity for you to make a comment if you'd like.
I checked with Shonda and haven't heard back, so I'm not aware of any public comments.
Okay. Thank you, John. Thank you. Okay, our next one is the approval of the agenda.
I'll move to approve.
Thanks, John.
I'll second.
Okay, all in favor?
Aye.
Aye.
You opposed? Thank you. Okay, we'll go through the minutes. Our minutes are from our meeting, June 22nd, 2021. I'll scroll through kind of slowly. Your numbers look good last year. They always look good. We had them everything on
the good old days last year.
They're coming back, John. They're coming back.
Yeah, we hope.
Okay, they're just standard items that are on your agenda this year as well. So we'll go through each item. So with that, can I get a motion to approve the minutes, please?
I'll move.
Thank you, Marlene.
I'll second.
Thanks, Bob. All in favor?
Aye.
Aye.
Be opposed? Okay, then we'll bring Carrie on. And Carrie, I have the 4:30 report on the screen.
Excellent. Yeah, and I apologize, but not going to have a lot of good news for you here. But hopefully I can answer some questions about what's happened and looking forward. Is there any hope, going forward? So I'll address that question in a bit. But first, let's look at this snapshot of April 30th. April was a really rough month. You see the asset mix there in the upper left. The alternatives are the real estate investment trusts. So those are equities. Pardon me. So looking at your total account net of fees for the month of April, it's down 6.63%. Year to date, down 14.2%. Last 12 months, down 11.5%. Up 340 per year each of the last 3 years. 393 per year each of the last 5. 447 per year for 10, and 434 per year since inception. It's really difficult in times like this to just look at one number, a year to date, a quarter, and go, these are longer term investments. We really should be looking at 3 and 5 year returns. We always look at the month and the quarter and the year because those are important, but these are longer term, so just keep that in mind. But I want to highlight the year to date column just to give you an idea through April what's happened. The S&P 500 was down 12.9%. So the largest 500 stocks in the US were down 12.9. The smaller stocks were down closer to 20. Then if you look at that 12.9, okay, Scott and Roz, you guys cannot answer this extra credit question I'm going to pose right now. Extra credit. Roz will determine what the prize is, but there's only one sector of the economy that is positive this year in terms of total return. Can anyone guess what it is?
Real estate?
No?
Not real estate.
Medical?
Not medical.
Can we narrow, like, are we talking narrow, like, well, no, the big drug manufacturers don't just have COVID, but.
Yeah, not medical, not pharmaceuticals.
Like Amazon or?
I'll give you a hint. I recently saw a picture of this selling for $8 per gallon.
Oh
yeah, energy.
Yeah, energy.
Energy is the only thing. Energy's up almost 40% this year. Utility. Now I just lied. Utilities are up 2%. Okay, so I'm a liar. Everything else is negative. Literally everything is negative this year except for energy. Interestingly,
up 40%, Carrie, or 4?
Yeah,
40.
40.
Oh
yeah. Wow. Which all kind of makes sense when we go to the when we go get gas. You know, it kind of makes sense.
So, Carrie, do you see like there's an emphasis, you know, in recent years on socially conscious investing and avoiding things like investing in petroleum. So, you know, during this period, you would have lost out on some gains avoiding those investments. Would you say being socially conscious investing kind of evens out over time, or just depends?
John, that is such a great question. Yeah. And it's a fabulous question because ESG investing, socially conscious investing, like you're talking about, is a huge trend in the last 5 years. And to put it mildly, let's just say that movement doesn't like fossil fuels. And I think we'd love to see ourselves, you know, get all our fuels from something else. But clearly our economy is not there yet. I mean, and we're seeing that now. I mean, gas was $42 a barrel a year and a half ago, and now it's $115, possibly headed to $130, $150 or so. Natural gas, now we're in California, so we don't have to worry about heating too much, but the East Coast was just killed this winter in terms of natural gas prices. So we're just simply not there in terms of reliable alternatives. We're getting there, but we're not there yet. Texas, you know, land of every oil in the world, right? They get 30% of their energy from wind and solar. But then a couple of winters ago, they had a catastrophic event because they didn't have enough electricity. So they had a huge winter storm that came in, and you know those alternatives don't work in that environment. So, but yet this year, in the last year, that's been the investment that's done so well. I don't really see it changing, John, because it seems to me just like, you know, we were energy independent and we're not anymore. I believe I heard yesterday, President Biden is now either going to Saudi Arabia or asking Saudi Arabia if we can buy more of their oil. And we have a ton of oil here, yet he's not allowed to issue more permits or reduce some regulations because some of the folks on the far left side of his party won't like that. So we're in this really interesting, and President Biden said about a week or two ago, he said, yeah, some of the pain is still to come, but once we get through this, it'll be much better. Kind of implying, you know, we have to fully transition to alternatives. So this is just kind of the price to pay to get through that. So to answer your question, John, I don't know where this goes, but there's a lot of reality of the way our economy works that's hitting people in the pocketbook right now. You know, the average family is paying about $600 a month more for energy and food. That's a lot of money. I remember back when I had a couple kids, wife making 80 grand a year, man, I didn't have $600 extra a month. So I honestly don't know where this ends, John. I don't, but there is rethinking of ESG in general. There is some of that, but a lot of the ESG, or most of the ESG, is really in private foundations. You know, let's say you retire, John, and you decide to donate half of your $500 million estate into a private foundation. You know, you can do whatever you want there. You could do ESG. You could prioritize the investing however you want. And a lot of private foundations, that's how they do it. In the ERISA world, the pension world, which technically we're not ERISA, but we're very similar to ERISA, it's much more difficult to put those restrictions on pension assets because you have to invest for the benefit of the underlying participant. But there's absolutely a rethinking of what's going on right now because of that, I would say. So going down the column year to date, the international index is down 12 and 11. And this is the killer. See the BBG Barclays Aggregate Bond Index down 9.5%. Those are U.S. bonds. And the main problem with this year, you guys, is stocks go down. They do that occasionally. We've all seen it. But we've never seen bonds go down like this. Bonds were down 10% the first part of this year. Bonds don't go down 10%. I'll explain that a little more in the market commentary section on why that happened and what we think going forward, which is actually more positive going forward. But then finally finishing out that column, global bonds down 11.25%. And then 50-50 mix, just a handy number to have. Global stocks and U.S. bonds down 11.25%. If you go to the next page, we did make some changes.
Carrie, can I just ask a quick question? I'm just curious on the previous page on our mix of assets. We're at 56% fixed assets, and looking at our the appendix to our policy, the goal is 55. So, we're right at it. And I was just curious, there's always going to be fluctuations and things moving up and down. How closely, and I wouldn't be a stickler at all when things fluctuate, those percentages being off at certain times, but how often are reinvestments done to get back into the goal mix?
Sure. No, it's a great question, John. So you're in our per year investment policy statement. You're in our model portfolio that has 45% equities, 55% target bonds. By policy, we have to rebalance if we're 5% away from those targets.
Okay.
I'll tell you, practically, we rebalance way more often than that. We never let it go that far. We continually monitor this. This one happened to be, you're now 1.3% away because you should have 55. Now you're at 56.3. You're away from that because in early April, about April 3rd, we did some portfolio changes. What we did is we didn't change the stock to bond mix. But what we did do is we moved some international to domestic to reduce the risk of the portfolio. We also added some real estate to reduce the risk of the portfolio. And we also moved more of your money from growth stocks into more value-oriented stocks, which included some energy in early April. So we did that on April 3rd, but then April was a terrible month for stocks. So while we were 45-55 after the rebalance on April 3rd, because the stocks went down more than the bonds did, you ended up at 56.3% by the end of the month. But you're usually within a percent or two of that target.
Yeah, I was just curious. Thanks.
Yeah, I didn't think of that. As an asset class grows or expands, that'll change the percentage mix based on how the other asset class performs.
Exactly. And then in the past, Scott and I obviously we were involved because, we work for you, but I remember just simply we were able to rebalance in March of 2009. I remember that. And we rebalanced in, I believe it was April or May of last year also. But just those rebalancings made a big difference because, those were dramatic moves down in stocks. So just rebalancing, allowed us to add a little more into the market at the low points. And that's what we're trying to do.
Mhm.
And Carrie, I'm guessing that you're going to be talking about projections a little bit later on, right?
Absolutely. And anything
Okay.
else you want me to talk about? Yeah.
Perfect. I'll wait till then.
Yeah, I think after we take action on this, open season, we'll talk about markets, projections, everything.
Yeah, so if there are no more questions pertaining to the actual performance report, then I'll open it for a motion to accept the report, and then Carrie can go further into the market commentary.
I'll move to accept.
Thanks, Bob.
I'll second.
Thanks, Marlene. All in favor?
Aye.
Go ahead, Carrie.
Hey, Roz, could you turn to the page that has the model portfolios? There you go, 18.
Oh, here? Okay.
18, yeah.
Yeah.
So these are the portfolios, the model portfolios. You're in our moderate growth portfolio. Every component of this is selected because, in Morgan Stanley's opinion, these are some of the best money managers in this space. And these recommendations go to Benefit Trust Committee. And only after they approve them do they end in your portfolio. These are all institutional share class funds that are extremely inexpensive. And typically there's like $500,000 to $1 million or $2 million minimum to get into each one. But because we pool all the assets, we have access to it. If you scroll down a little more, Roz, you can see the expense ratio. These are the aggregate expenses of the underlying funds. You see they range from 48 basis points over on the left to 61 to 69. You're in the 61 basis points. That's you're roughly 0.6% of internal fees from your funds. Now, when we look at those, man, like let's take, for example, see all your fixed income funds there, Black, Guggenheim, PGIM, Western, PGIM, Guggenheim, and you'll see their fees in a 0.37, 0.49, and so on. When we're analyzing these managers, we're always looking at them and saying, does it make sense to pay BlackRock, for example, 0.37% to actively manage that fund versus we could just buy a Vanguard Barclays Aggregate Bond Index for about 0.12%. Well, all of these managers, they do perform better net of fees than those indexes. And that's why we have them in there. If we didn't think they would, then we can just buy indexes. We're very open to that. It's just what's kind of fun about what we get to do is we have access to some of the best managers in the world. So they always outperform their indexes, even net of their fees. But just wanted to get that little administrative piece out. So last time we met, Roz, I believe it was, what'd you say? It was June or September?
No, it was June. We always meet them in June.
It was okay. I thought I saw a different date from the minutes prior. So I want to explain why the bond market has reacted and give you an example of how dramatic it reacted. Last August, the Federal Reserve came out. They have their minutes of their meeting. They meet roughly every other month roughly. And they came out with the minutes of their August 2021 meeting. And they said that they believe inflation is transitory, shorter term, and they don't anticipate raising short-term rates till 2024. Fast forward just 5 months of December, the minutes of that meeting came out and they said, we're going to aggressively raise rates in 2022. And throughout COVID, they've been buying lots of bonds. So they've increased the size of their balance sheet or kind of their saver portfolio to a little over $9 trillion because they were buying about $150 billion of bonds a month. Well, they're going to start reducing that by about $85 to $95 billion a month. So what will happen is by them increasing rates and by them selling off bonds from their portfolio, that takes dollars out of the economy. And the goal of taking dollars out of the economy is that should help with inflation, but that's their goal. Well, they're just way too slow in getting to the party. They should have done this a long time ago, and now they're trying to play catch up. And that's why in the first quarter, we had the worst quarter ever for bonds. And to give you an example of that, a 5-year Treasury was yielding about 0.5% at the beginning of the year. End of the first quarter, it was yielding 2.7%. Well, if you bought a 5-year Treasury on January 1 that was yielding 0.5%, and then you just held it, at the end of that quarter, you lost about 9% in the value of your bond.
Wow.
On paper. Now, you hold it to maturity, you'll fine, you get everything back. But just on paper, you lost 9% on that. Just astonishing how yields went up. The 10-year Treasury yield, which is probably the most important yield in the world. Mortgages are based off of that, and so many different things are based off of that. We were at 1.5% on January 1 of this year. And by the end of the first quarter, we're at 3.1%. We're now down to 2.97%, but those are huge moves in bonds. So a lot of people might ask the question, okay, so bonds weren't a safe haven here during the first quarter. Could they be a safe haven going forward? What do we think going forward? Well, again, like I said, last quarter, it was not a safe haven. It was the worst quarter ever for bonds. But we don't believe that's the trend. The beauty of bonds, what I love about bonds is bonds mature. In that 5-year Treasury example I gave you, you hold it 4.5 more years and you get all your money back, and then you just reinvest at higher rates. Bonds mature, and that's what's going on in your portfolios. We expect from this point forward that returns are going to be much better than they were prior to this, simply because rates are higher. And I'll give you an example. Let's say you're the manager of that BlackRock fund, and the 10-year Treasury was yielding 1.5%. And you're looking and you've got money to reinvest in the mutual fund. You're managing about $10 billion of funds, and they've got bonds maturing every month. You got to reinvest. Well, interest rates are so low that your returns going forward are going to be really low. Well, now the 10-year is closer to 3%. You're going to be getting about double the return that you would have gotten 5-6 months ago. Now it's been pain getting to that point, but going forward, you're going to get much better returns. Your bond funds now are yielding, over 4%, between 4 and 5%. So I believe going forward that returns on bonds are going to be significantly better. We also believe that long-term rates have kind of reached their peak. 10-year Treasuries around 3%. We think it's going to be around there. We don't see it moving to 4 or 5%. And part of that is because the economy is slowing. Inflation is actually starting to slow a bit. Now, nothing to write home about. It was 8.5%. Maybe it's 7.5% now. I mean, it's still a terrible number, but the joke I like to use is, if your son brings home F's in his papers all the time, and now he's bringing home a D-, you're mildly optimistic. We do see inflation moving down a bit. We're thinking maybe it's closer to 5% by year end, and we think maybe closer to 3% by the end of next year. So we see inflation moving down slightly. We see long-term rates have kind of stabilized, which is good. We've seen bonds rally the last couple of weeks. So we think projections for bonds are actually pretty good going forward. I think 4% return for bonds are not unrealistic at all. Another interesting thing about the bond market is the Feds are raising rates. Now they're definitely going to raise another 0.5% in this month, 0.5% next month. But then it gets tricky because then we're into August. The election's around the corner. Are they going to continue to raise rates into a slowing economy and inflation slowing down? I don't know. But for the first time in the last week, we heard a speech from one of the Fed governors who brought up the idea that they wouldn't automatically raise rates all throughout the year, that they would maybe reevaluate in August. Because the projections is that they're going to raise the short-term rates, which right now are 1%, to 3.5% by next year. And what this Fed governor was saying is, hey, we're definitely going to raise 0.5% this month and next month, get us to 2%. But maybe we'll pause and kind of see how the economy is doing. Because what they don't want to do is they don't want to raise rates so much that they push us into a recession. And that's going to be tough to do. So that's what we're watching. Now, on the stock sides of things, as I think I explained by those portfolios changes, we're just extremely well balanced. We've got way more in domestic than international, more in real estate, more in value. We're just not taking any risks really in anything. We're just trying to stay balanced because we are in a difficult position right now. We don't know where earnings are going to come out to be. Now, if you look out 2, 3, 4 years, which is appropriate for equity investors, I mean, it looks fine. But over the next 3, 4 months, we really have to get some good news on inflation, the budget, earnings, things like that before we really start to see equities move up. And I'll just leave you with one final thought. The good news, though, on stocks have corrected a lot. They're not expensive at all. Now, they can get cheaper just because there's so much fear in the market, but they're not expensive. This isn't a January 2000 situation or a December 2021 situation where the market as a whole is pretty expensive. It's just not. It's come down. It's reasonably priced. So that's why we're just staying balanced, and we believe long-term rates have kind of stabilized. So, yeah, Marlene, did you have a question you wanted to ask me? I think, or about like projected returns, or
You answered them. I was going to ask about the projected speed of recovery and the curve of that recovery. That I know that even though we might have had historical moments where we saw extreme inflation, but the circumstances I think we're facing now are really unique with war in Ukraine, with COVID and its impact on the global supply chain, with their labor force disruption. And so I was just going to ask you what you saw in the future, even though I don't know that we have a good historical basis that we could base those projections on, that it's really unique what we're facing.
Oh, you think? Yeah, exactly. We've never shut an economy down. I mean, we've never done that. We got the jobs report this morning, which comes out first Friday of the month, and it was good. There were 390,000 jobs that were created, which was better than expectations. That's good, but a huge chunk of those jobs are just what we call service sector jobs, like restaurants and things that we all know. We've all been to restaurants. We all know they're short-staffed and they're trying to hire. Well, they're starting to hire. Well, those aren't the kind of jobs that really propel an economy to that next level. So what we're saying is that, and how we're trying to position your portfolio, is for much slower growth in the economy, higher than average inflation, and that's what we're trying to prepare for, which is not a real rosy outlook. And I apologize, but we always want to be honest with you on what's going on. Got to get some of these energy numbers down, though. These are just people are changing their behaviors based on prices right now. They're traveling a little less, and at least by car. Any other questions on anything? Lots going on right now. And
well, with the equities market, I think it was pretty clear it was overvalued for a while, Carrie. And I know we've seen the adjustment. I think the question is going forward is, are we going to see some, sanity return to the value of stocks? Because it seemed like there was too much money chasing too little things. And now we have real estate, which appears to be cooling, which is probably a good thing as well. But do we see the equities market growing slowly going forward? Or do we see, remember how we had the downturn and then we got almost all of our value back within, a really short period of time? Do we think it's going to be that again, or do we think it's going to be a slow return?
Bob, you bring up a good point because, yes, the general markets were up, double digits, almost 20% a year for 3 years, 19, 20, 21. Though those are really high returns.
Right.
We got a little spoiled by that. And a big part of that was that the Fed put lots of money into the economy in terms of quantitative easing. Well, now they're realizing that that was a mistake. They need to take that out. We don't know what the effects are by moving a $9 trillion balance sheet, moving it down to $6 trillion or $5 trillion. Marlene said, we've never done this before. We've never been through a pandemic. We've never reduced a balance sheet that much. We don't know. But we do know it means slower growth, because you're right. There was a lot of speculative money chasing a lot of these speculative names that didn't have earnings. But we're also in a situation now where there's a lot of companies that are incredibly profitable right now, where their stocks have just gotten hammered because, like, even, fundamentals kind of be damned in a way. I don't know if you guys travel much with Airbnb, but the company's making money, right? Hand over fist. They're doing so well. Their stock has been hammered. And that's not a recommendation to buy. It just means in this environment of lots of fear, you don't get those more aggressive names trading up. You get names more like Costco and Exxon tend to do better, stable companies. But Bob, going forward, we think slower growth for stocks, slower returns. But we got to get a handle on inflation and energy costs. We just have to, because it's just crucial to the economy. I'm encouraged the last few weeks, and then we've seen the bond market stabilize, because I really believe that equities have been getting their signal from the bond market. So if bonds continue to stabilize, then that's a very good sign.
Terry, have they stabilized more in the month of May than they were at the end of the quarter? Have you seen?
Yes,
okay.
Absolutely.
That's crucial there.
Yeah.
Okay.
Mortgage rates are up a lot.
Yeah.
So you're seeing a lot of, what I hear from my realtor friends, and I don't know how it's down in Southern Cal, but we're hearing in Northern Cal, is homes are still selling at the prices they're asking, but there's not as many offers, and it's taking longer.
Right.
And you're not getting the bids way above offer like
right.
you were before.
Like you were 4 months ago. Yeah.
Yeah.
I just experienced that. We just bought a home recently and watched interest rates go up about 1% in the time we were looking for a home, and since then maybe another %.
Yeah.
Yeah.
Yeah, you were looking at like low 3s, 30-year fixed, and now it's like what, 5?
About 4.1 is our loan, and now 5.
Yeah, now it's about 5.5, Carrie. It's and in December it was like 2.9 for 30-year fixed in December.
That's a big difference.
It's a huge.
Yeah.
It's a big difference in a payment. Yeah,
a huge difference. Yeah. And although there's not a lot of inventory out there, when I was trying to sell my home, it was just crazy people coming, lots of people bidding wars. But now with the interest rate so high, people have backed off and like changed their mind and like waiting because they high interest rates on home loans.
Yeah.
We were wondering when that was going to. We were wondering, just, seeing the market, other people's experience of the crazy outbidding. And my daughter's up in Northern California and tells us about people outbidding hundreds of thousands of dollars, and wondered when that was going to level off. It didn't. Right. It didn't seem to be happening a few months ago when we were looking, but I suppose it has to happen now at these rates.
It's still it's still there though. Still there. So I wanted to just tell you, Carrie's office, Morgan Stanley, always gives us lots of information. That's what I love about them. We send out that monthly market update by email. So, and I always include information in your file in your package whenever we meet. So it's a really good article here talking about the mid-year growth. So take your time to read that. It's included in the packet here under the market overview.
And you can always reach out to me individually. Roz has my number. You probably have my number. anytime. I mean, these are crazy times. So I always want to offer that.
Absolutely. Thank you so much, Carrie. Okay, we'll move on to the next item, which is the investment policy statement, and I'll just hand that over to Scott to talk about.
Yeah, so every year, once a year, we bring up the investment policy statement to get it up on the table so that we can get a look at it. Carrie and I have looked at this. We don't see any changes that we're recommending this time around, but if you all have any questions or comments or concerns, or if there's just anything that you think that is material to the cause that you think that we should know in the course of managing your portfolio, this would be the time today that we could talk about that. Anybody have any thoughts?
I'm good with where we're at.
Okay. Marlene, Bob, have you got any questions or comments on the investment policy statement?
No, I think I wouldn't have any changes. I think what we're experiencing is an aberration. So I think continuing with the statement is appropriate.
Very good.
Okay. Can I get a motion to reaffirm the investment policy statement?
I'll move.
I'll second.
Thank you, Bob. All in favor?
Aye.
Aye.
Thank you.
Thank you.
Our next item is the annual reporting on the status of the trust. So as you know, each year in July, we present the cover letter along with the annual statement where the district then posts it on their website. This is an information item. This was done last year. So in July or late June, expect to receive a copy of the letter. And can you look at the top? Are these Board of Trustees still the same or did they change?
Douglas Otto is no longer, and or Linda Chico needs to be added.
Okay, and the superintendent is still the same too?
No, it's very, very, very different. So, John, I don't know if you could ask. Shonda's out today, but if we could get them the updated information.
Yeah. We'll just send the letter to Shonda and then have her copy it on your current district letterhead.
Perfect. That's perfect.
All right, guys.
Yeah, we had our new superintendent president, Dr. Mike Munoz, was appointed just 2 months. Was it been 2 months or 3 months? Something like that. He was interim for quite some time. Yeah, he was interim for quite some time before that.
Oh, okay. Gotcha. All righty, and we'll still use John as the contact person.
Yes.
Yes. Okay. Our next item is the disbursement report. So I'll pull that up. These are the fees that were paid to each consultant, Keenan, Morgan Stanley, and Benefit Trust. The fees they come out of the trust directly at the end of the month, and they are based on asset value at that time. I'll just kind of scroll through, and you can see the fees since we last met in June through April. Okay.
And just to clarify there, Rosalind, as the portfolio balance drops, then the fees are reduced as well because they're a fractional percentage of.
That's correct, Bob.
Got it. Not that they're not doing a great job. I understand you can't control the economy.
It's only fair, right, Bob?
No, we should get less. Absolutely. Yeah.
All right. So this is an action item to ratify the fees. If I can get a motion, please.
I move.
Thanks, John.
I'll second.
Thank you, Bob. All in favor?
Aye.
Aye.
Guys. Okay, that brings us to our actuarial valuation study. As you are aware, GASB requires that this report is to be completed every 2 years. However, most clients now elect to do an off year, what's called an update. I believe this is an update. I don't know if this is a full study or not, but this was done based on the measurements through June 30th, 2021. And I'll go through.
This was a full study where they're working on their what they call their roll forward to update our financial statements and footnotes. But 2021 was the full actuarial study.
Okay, great. So I just pulled up this page here to show find your total liability. Okay, your total OPEB liability as of June 2020 was slightly over 44 million. You had an increase, and that may be because of the SERP you did, but your total OPEB liability now is 45.6 million with a net position of 10 million, leaving you a net OPEB liability of about 34.6 million.
Yeah.
Your discount rate is 3.31. It moved from 3.70 for your discount rate. Your service costs are about the same. Your pay-go went down from 2.6 million to 1.7. Any questions on the actuarial study? Okay.
No.
Awesome. Okay, that brings us to the the auditor's report. Each year, the district provides us with an audit report. This report goes into, as well as the new actuarial study, goes into your substantive plan, which we will be collecting data for beginning in July, and then send you an update as we usually do on a flash drive that has all your information pertaining to anything related to the OPEB trust and the retiree benefits. So this is your independent audit report. It was completed for year end June 30, 2021. It's just an information item. Any comments or questions on the audit report?
No.
Clean audit. No
Yep.
findings. We'll move on to the next item, which is the update to the comprehensive compliance plan, including the substantive plan. Let me get there. Oh, it was huge. So each year, we provide you with a questionnaire, and it's asking, were there any changes to the retiree health benefits for that particular year that were different than the previous year? So click on that. Okay, here we go. So here's the questionnaire. This will be sent off to you, John, and if there were any changes this fiscal year, if you move from Blue Cross to Kaiser or changed any type of benefit structure, you do have a new actuarial study that we have, and we'll include that in there. But there doesn't appear to be any significant changes. We'll make sure that we have these bargaining agreements that are included. But it looks like there were no changes last year to the benefits that were different from 2020. So the same questionnaire will be sent to you. Were there any changes this year to the retiree health benefits? And if there were, if you answer yes, and then Kristen will work with you to collect all that backup data, and then we'll get you a new substantive plan somewhere around the fall. Okay. Okay, that brings us to our next agenda item, which is transfer of assets to the trust. I believe, John, there was a deposit early on. You typically have an annual deposit of about 80,000. Is that correct, John?
That's true. Last year it was over 100,000, and we do it based on the percentage of salaries paid through federal grants, and we have more of those salaries recently because of the HERF funding. We get the federal COVID funding, so we expect to be over 100,000 again this year, and we make that deposit annually in August, September, after our year end closes.
Okay. Any questions for John pertaining to that? Thank you, John. Okay. That brings us to our information section. Were there any questions from the Retirement Board of Authority members? Any comments or questions that you'd like to make and include in minutes at this time?
I do want to share, in case you weren't aware, that this will be my last meeting with Long Beach City College. I am moving to Coast Community College District effective July 1st.
Oh my God, are you taking Dr. Dunn's position?
I am.
Oh,
I get to be the new
Congratulations.
That's awesome. So you'll still see us.
I sure will. I sure will. I know that it's interesting that they have split their approach. So they have two different. I was able to attend the other from the league, their meeting up in Tahoe. I'm looking forward to continuing to work with you.
Oh, that's awesome.
Awesome.
That'll be great.
Congratulations.
Thank you so much.
I'm sorry to see you leave Long Beach, but at least, you're going somewhere great. So
Yes. I have a lot of mixed emotions. Long Beach is fantastic. I'm certainly going to miss working with John and Bob, but I know that the district's going to be left in good hands.
yeah.
How long have you been at Long Beach?
4 years now.
4 years.
4 years.
Well,
Although,
congratulations.
thank you. 2 of those years were COVID years, so it feels like 20. So
For millennials, that's called a career.
Yeah,
Right.
exactly.
exactly.
Yeah, maybe you know how we do say dog years is like 7 years.
Yeah.
So maybe there's a new term, COVID years. Maybe
Yes.
there'll be something coined. I don't know what the denominator.
I think
Factor will
we're
be,
already
but-
using it. I don't know exactly what the ratio is, but it feels like an eternity.
I've never heard that, but it's so true. It feels like those 2 years feels like 10 years. I've never heard 10 years, but I'm going to use that.
Well, we're dying to get down and looking forward to seeing you next time in person.
We'll be in person.
Well, we'll see you
There you
at
go.
Coast, but everyone else in Long Beach.
In person.
We'll be there. And you have the best, you're going to have the best admin. She's wonderful.
Rosalia, right? Rosalie?
Rosalie.
Yes.
Rosalie is wonderful.
She's already been super helpful.
Yeah.
I was appointed about a month ago, so it's been a long-term transition, which has been very nice since Dr. Den is retiring. But it's also provided Bob and John an opportunity to have me finish some things for them before I go, so that they can be left in some good shape.
Well, congratulations,
Very
Marlene.
good. Congratulations,
Here,
Marlene.
girl. We are going to miss you here. Any comments or questions from Scott and Carrie? Do you have anything you'd like to add before we close out the meeting?
No, just say thank you. It's good to see everybody.
Yeah.
Yeah.
Thank you all so much. Enjoy your weekend.
Yeah, just a reminder, John and Bob, we don't have to wait a year to meet. If there's something urgent or something going on in the market, you can always call us and we can schedule a meeting at any time. Okay.
Okay.
Thanks, Rosalind.
And Scott really prefers January or February spontaneous meetings because that allows him to fly out of Kansas City, and avoid the winter. So
My blood gets
Sorry.
thinned out though. I go out there in February and then I come back here and I shiver.
All right.
thank you all so much.
Yeah, thanks to you guys too for this meeting and the service throughout the year. Rosalind, we'll have a replacement for Marlene who'll be on this board. Do you want to touch base as far as scheduling for next June, maybe sometime in September or so?
Yeah, we can do that and wait. Yeah, we can do that. Or we can put something on the calendar and then always change it. But yeah, I'll wait.
Yeah, I'm fine with that. If you want to put something on the calendar and then we can adjust as
right.
needed.
That's perfect. That's what we'll do.
Okay, great.
All right.
All right.
During the
Thanks,
weekend,
everybody.
9:49.
Thank you, everybody. I appreciate